session on policy space in a world of mobile private capital. We have four speakers. The first speaker is Martin Guzman, I'm going to Spanish. Martin Guzman, who is professor at School of International and Public Affairs in Colombia and former Minister of Economy of the Republic of Argentina. Laura Barbosa de Carvalho, Brazilian development economist and director of economic and climate prosperity at the Open Society Foundation. Chandrasekhar Chandru, who is a former professor at Jawaharlal Nehru University, global director for Research and Policy International Development Economic Associates, IDEAS. And Ndongo Samba Sylla, Head of Research and Policy for Africa International Development Economics Associates, IDEAS. I'll give 15 minutes to each speaker, and then we will give the floor for you to ask questions. So we begin with Martin Guzman. Please, Martin.
Thank you. And I have a presentation, so an newcomer, if you can project it, that would be good. There it is. Yeah. Oh, should I use the podium?
Yeah.
Okay, fine. Oh, it looks like I have something here. Let me see if it works. Not really. No. Where is the computer?
You have to point in that direction. No, it doesn't. Yeah. You should point it like that.
Where? That way.
Yeah, body. Yeah. Oh no. What's happening?
No.
Yeah, please come back. Yeah.
Okay. All right. Thank you for the invitation. Thank you, Chandru. It's a pleasure to be here. Also close to home, and always such a pleasure to be in Rio de Janeiro. This was a session about the capital flows in the global economy, and I'm going to focus on a specific theme that matters for sovereign nations that are today in situations of debt distress. This is based on joint work with Guzman, Kessler, Sonway, and Joe Stiglitz. And it's about addressing the current sovereign debt crisis after three big shocks in the global economy over the last 16 years, which was the Lehman Brothers fall and the bailout of the American government to the banking system and quantitative easing, the COVID-19 pandemic, and the war in Ukraine and the response from central banks in advanced economies. So let me set the tone by describing the context. These three shocks that I described have led to a situation of, I would say, massive debt distress in the southern hemisphere. First, in 2008, what we saw was a creation of liquidity that became global. So we all know here that the global interest rates were close to zero, and that led to a search for yields, and money flew, and it flew not just to emerging economies, but also to low-income and low- and middle-income countries, many of which were able to issue bonds and place them in international credit markets for the first time ever. And then we have the COVID-19 pandemic, which led to more stress in public finances in several countries. And finally, after the war, the increases in interest rates and quantitative tightening, undoing the creation of lower liquidity of the previous decade. and that led to more expensive refinancing, and therefore we had countries falling into situations of defaults or just impossibility of accessing international credit markets. What you see here is that the external debt of the poorer countries in the world, the low and low middle income countries, has increased, especially since 2008. This has to do with what I just described. There was more access to liquidity. It's not just that countries want to borrow, it's that they can borrow, and the international financial system wants to lend to them. They actually, when you look at the colors, you will see that the biggest increases in the light blue bar, which is debt with the international private sector, mainly Wall Street. And the situation now is of distress in the context of an architecture that is not ready, that's never been ready for dealing with these situations. Jan Kregel was referring earlier to the global system that we have, and when the Bretton Woods institutions were created in 1945, something that we did not have was the equivalent of a bankruptcy system, but for sovereign debtors in situations of unsustainability. So we have a system in which there are decentralized negotiations when debts become unsustainable between the debtor and the creditors, and there is a myriad of creditors, many different creditors with different business models, different incentives. This process of restructuring the debts are highly complex. In the economics literature about debt crisis, there are two big libraries. One library focuses on the problems of commitment. Basically, it says that the reasons why countries are not don't repay at times is lack of commitment. The other library focuses on the problem of sustainability. And basically, it departs from the assumption that we are in an environment in which we can't index the payments to every possible contingency. We can't even know the multiple contingencies that may arise in the economy. So there may be situations in which the scheduled debt payments are simply inconsistent with the resources in the economy. And therefore, something has to adjust. There has to be some form of restructuring. So that's not a problem of commitment, or not neatly a problem of commitment, but it's a problem of capacity to pay, which is actually something that happens in the real world. And in those situations, that's what justifies the existence of a risk premium. Creditors get compensated when they lend to emerging economies or to developing countries in general by a risk premium. Basically, that recognizes that there may be situations in which a restructuring will be needed, but the contracts don't stipulate what are the circumstances under which a restructuring should occur. So then there is a fight, there is conflict. The creditors don't want to restructure. Even the debtor might not want to restructure because of political economy reasons. It might be too costly for the debtor to restructure the debt. So what we have typically is this problem of too little and too late. It takes too long for a restructuring that is necessary to restore economic growth to be initiated, and once it's initiated, generally it's not deep enough to take the economy out of trouble. Our paper is a policy paper. It focuses on what's going on now. There's been not just a debtor-creditor problem, but also evolving inter-creditor problems, because we have a different set of creditors today than the set of creditors that were prevalent in the 1980s. The global economy changed. China has a much more important role, India as well, but not as China. And the initiative of the G20 in 2021, the common framework for the treatment of unsustainable debts, simply failed. It was a total failure. Things are not being resolved. So what we do is first we show what's going on in terms of the capital flows. In that chart, what you have is a description of the net transfers across different creditors to debtors. And you see that in 2022, there were positive net transfers to low and low middle income countries of 32 billion from the international financial institutions. And at the same time, negative net transfers of minus $51 billion to private creditors. That's a bailout. That means that when capital pulls out from the private sector, the global taxpayers are basically financing that capital flight. So the money from international financial institutions is not being used for counter-cyclical economic policies or for growth policies, but it's being used to bail out mostly the Wall Street creditors, as it's been since we have sovereign debt crises are back in the global economy, mostly after the end of the Bretton Woods regime, the Bretton Woods system. So things clearly are not working. So we chart a proposal which builds on an old proposal that we had certain problems. I'm going to describe this in some detail. I think I have maybe 7 more minutes. But before I move to that, I'll do 2 clarifications that are key to understand the nature of the workings of the economy for the kinds of economies that are suffering sovereign debt distress. First, these economies are not like advanced countries in which the capacity to do counter-cyclical macroeconomic policy is mostly related to fiscal policies and financing in domestic currency. These are countries that face what we call the external constraints. They have weak currencies and thin capital markets. So the capacity to grow to a large extent depends on the availability of foreign exchange. It's not just that they can resort to domestic capital markets around a counter-cyclical fiscal policy. They need foreign exchange if they want to do counter-cyclical policies. So the 3 main options, if there is no debt operation, no debt restructuring, when they face a situation of external distress, is either to contract imports, that mostly means a recession, so that's not counter-cyclical, to expand exports, but that doesn't occur in the short term, even if there is a depreciation of the real exchange rate. Exports are not that elastic in the short term, and they depend on a number of factors. Or what we've seen, a depletion of the foreign exchange reserves, which doesn't end nicely, okay, if there is no external debt operation. So they lack the capacity for counter-cyclical macroeconomic policy. And they face an adverse nature of international capital flows. The global economy, the planet, can't trade with another planet. So by definition, capital flows for planet Earth are acyclical. But when there is a negative shock to the global economy, capital flows to the advanced economies, meaning that for the advanced economies, capital flows are counter-cyclical. Well, the math is trivial. If for planet Earth, capital flows are acyclical, but for a part of the planet, they are counter-cyclical, they have to be pro-cyclical for the rest of the planet, meaning that they are pro-cyclical for developing economies. In bad times, there is flight to safety. And the ecology of international financial institutions is supposed to play a stabilizing role, but it doesn't happen, okay? And again, the system for the restructuring of the debts doesn't really exist. It's what Jose Antonio used to call, I'm sure you still do, a no system for sovereign debt restructuring. So under that environment, our proposal is that the first thing that should happen is that there are no more payments of capital, principal, to creditors that don't provide refinancing. For official creditors, official bilateral creditors like China, a way around this quandary would be just to refinance the debts. That would count as a form of relief. It's the equivalent of extension of maturities. For the private creditors, what it's needed is debt operations that for the debt stocks, I didn't include the picture here, but for the debt stocks that these countries face today, it might not be necessary, actually for most of them, it won't be necessary to have a haircut on the principal. But what they will need is a long extension of maturity. Many of us think that for a long time, these countries will have no access to international credit markets. When they borrow, After 2008, it was a different global economy. We don't have that economy anymore. So extensions of maturity will be to be long enough, and there should be a process of reversal of the exposure of these countries to the international private sector. And this can be done through guarantees of the MDBs, but that also means that there is a transfer of risk to the global taxpayers. Therefore, the interest rates on the bonds with the private sector should be reduced to the rate of the World Bank. In the paper, we speak of towards a solution and not a solution. Why towards? Because we don't think this is going to work, because it depends on the will of private creditors, and there is nothing that guarantees that. As part of this proposal, there needs to be a change in the structure of incentives to encourage the participation of private creditors in these debt operations. And something key is changing the legislation in the jurisdictions under which debt is issued, mostly New York. About 50% of the debt of developing countries in foreign currency is issued under the law of New York. And today, when a country falls into a situation of arrears, default, it pays a very high compensatory interest rate. On top of the coupon in the bonds, on top of the contractual interest rate, it pays 9% extra. That doesn't make any sense. It was set in 1981 when the inflation rate in the US was 8.9% in annual terms. And it stayed like that. So there have been attempts to change this, and actually this is being dealt with now in the New York Assembly. It was passed in the Senate, but it's still pending in the Assembly. But that will alter the structure of incentives for participation. Countries need to come up with their own programs for restoring economic growth, but no financing from international financial institutions should be used for amortization of debts with creditors that don't provide refinancing. They should be used for countercyclical and for growth policies. So this is, we see the situation of debt distress growing, and I'm glad to see the title here, reforming, Retrofit for purpose reforming the international financial architecture, because this is not just these are not just financial or economic issues. These matters affect politics, and they affect the functioning of democracies. So we take them as a core issue for understanding the evolution, not just of the global economy, but of the global society over the next decades. That is one of the defining issues of the evolution of the global society. Let me stop here. Thank you.
Thank you very much, Martin. Then I'll give the floor to Laura Barbosa de Carvalho.
Hello, good morning, everyone. I don't have slides, but I'm not sure. Maybe I should still stand anyway. Yeah. I think it was great that Martin started, because the way I thought of structuring the presentation on the question of policy space in an era of mobile private capital was exactly by distinguishing first countries that face external constraints as the main reason for a lack of policy space, which I would say is the case of countries with little access to capital markets or thin capital markets, as Martin has described, that is denominated in foreign currency. And for those countries, I think Martin has described the situation quite well. The main constraint is really foreign exchange, and the ways out for these constraints depend both on the conditions of the international financial institutions and the conditions they provide, both by different types of conditionalities or reduction of conditionalities, allowing these countries to raise export revenues by engaging in structural transformation and development strategies, reducing imports more structurally, which is also related to industrial policy issues and other aspects of policy on the domestic level, as well as debt relief and so on. But I don't want to focus on these countries here. I think we are sitting in a country that, like Brazil or other middle-income countries, that instead we would think have much more policy space, and probably they do, because the large or the vast majority of their debt is in domestic currency. It has significant levels of international reserves, which allow them to, which is a big buffer for global financial cycles and external vulnerability. And still, we, in those countries, face a lot of constraints to our policy space. And I want to talk about what I'm going to call here, instead of, as opposed to an external constraint, stricto sensu, an inflation constraint. And I don't mean by saying that inflation itself is the constraint, but there are political economy aspects also related to that constraint that I think reduce significantly the policy space in these countries. And maybe the solutions are less clear, and I would like to bring this topic to the conversation. So in countries that have that more favorable external conditions, like Brazil or other middle-income countries, what we see is that still the global financial cycles largely determine the degree of freedom that central banks have to set interest rates, right? So we have all the evidence in the literature by Elaine Ray and others that looked at how, the Fed policy rate really is the main determinant through other, and the global financial cycles are really the main constraints to the degree of autonomy of central banks and for monetary policy in the global south. And this is true for countries that have, even for countries that have, that don't face an external constraint, right? So we see that in moments where, commodities are booming or the global economy is doing well, there is a huge inflow of capital for these countries, which allows them to appreciate their exchange rate, and through the exchange rate appreciation, achieve lower levels of inflation, lower rates of inflation, and that's how they end up having space to reduce interest rates, and at the same time, they also have more comfortable fiscal situations in those conditions, right? When the opposite happens, and the Fed raises interest rates, or the expectations are that Fed will raise interest rates or will stop their cycle of reducing rates, then you see a huge capital outflow also of these countries that are in this position, and this ends up depreciating the currency. And the devaluations then create inflationary pressure. And the reality of this is that you either see central banks starting to raise interest rates, and we don't, and we never get out of the trap of the high interest rates, or if they do allow inflation to pick up, political economy aspects come into play in ways that end up constraining countries in very similar ways to the ones that face the actual fiscal and external constraints. And the reality of this is that then what you see in financial media and everyone in the country is that every exchange rate devaluation and the consequent inflationary pressure is perceived by the mainstream analysts as caused by domestic reasons, and most particularly as caused by the fiscal situation. And it doesn't matter if the Mexican peso and the South African rand and the Turkish lira and the Brazilian real are all devaluing at the exact same time and caused by a global financial cycle. It doesn't really matter. The domestic analysts will associate the exchange rate devaluation and inflationary pressure with the fiscal position, with an alleged fiscal deterioration, and that will constrain the fiscal space of countries in ways that I would say are are very tricky to get out of. And maybe what I would do here in the minutes I have is to start raising some issues, because, I mean, let's assume we are able to then, you know, in many countries, we are able to get the international financial institutions to be countercyclical, to accumulate international reserves, to boost export revenues, and then you get to a situation in those countries where you have access to capital markets, you have domestic currency denominated debt, and then still you don't have autonomy for monetary policy. You have big fiscal constraints that are created by this exchange rate inflation cycle, and your policy space is still non-existent, right? And maybe this creates a challenge for all of us, which is even more dramatic than the one we are talking about. And I can think of a few solutions or proposals that are out there that could help us tackle this inflation exchange rate type of constraint. One of them has to do with the exchange rate pass-through itself. So trying to tackle the last step of the problem, which is how exchange rates, devaluations translate into higher inflation. I mean, if we have measures that look at that channel, maybe we can at least reduce a little bit the constraints that emerge in this kind of situation. But that, of course, involves big structural transformations. Like, to reduce the exchange rate pass-through is something that requires less reliance on imports of a certain kind that are very sensitive to exchange rates. It requires really a structural transformation of the economy. I can't think of mechanisms that reduce the pass-through just through regulatory measures or any, you know, trivial policy measures. So again, we're back to the question of industrial policy and structural transformation more generally. The other thing that we could try to do is reduce exchange rate movements or the volatility of the exchange rate. These are maybe measures that we can think of. Of course, capital controls are one set of policy measures that could help, but of course, with always the dilemmas associated with it, because it's, of course, not in a period of crisis that a country can establish them. Maybe in a period of boom, it would be easier. But of course, creating those protection mechanisms for exchange rates movements to be less sensitive to the global financial cycle, I think, is one way of increasing the policy space. The second has to do with more regulation in exchange rate markets. So for instance, if we see the evidence for Brazil, the Brazilian real seems to be more volatile and respond more dramatically to these financial cycles than other emerging market currencies of similar commodity exporting countries. So there are many researchers trying to look into this question. Why is it that, you know, whenever we see a situation like the one we faced a couple of weeks ago, when the Fed did not reduce rates and everyone expected them to, and then out of a sudden you see an outflow of developing countries. And in that situation, the Brazilian real, for example, devalued more than most currencies. And so this is an issue for Brazilian economists that has been attracting a lot of attention. And it seems that there are issues with the derivatives markets of Brazilian reals that end up affecting the spot exchange rate quite a lot and creates volatility. Maybe that's one hypothesis. But there are proposals out there that put regulation in exchange rate markets as one possibility for reducing the sensitivity to the global financial cycle. And finally, I think the other maybe unexplored channel or possibility of increasing fiscal policy space on that front is being put forward by Isabella Weber and others who are thinking about buffers to reduce inflation, or at least to, building stocks and things that actually reduce these globally determined inflationary processes, right? So questions of stabilization mechanisms that can be coordinated between countries to deal with this type of, at least when the source of inflation is energy prices and other pieces, other supply side shocks, there may be coordination mechanisms that can create buffers that reduce inflationary pressure. I don't think it works for every type of inflation, and for exchange rate pass-through type of inflation, it's a lot more pervasive than the sectors that we are thinking of when we're talking about energy shocks like the Ukraine or food prices in particular, or any specific type of shock, right? It's inflation, exchange rate pass-throughs tends to be triggering price increases in almost every sector in the economy, including services, including non-tradable sectors, right? So maybe this is something that can help, but I don't see it as the big solution. And finally, I think the political economy piece matters. And so I think in general there is a narrative change and how to shape the economic policy debate in those countries in ways that at least reduce the type of fiscal pressure that governments have in these situations that are not linked to fiscal at all. And so the more evidence and the more research there is that shows that these movements, that is inflationary pressure, that these exchange rate devaluations are actually linked to global financial cycles, that are actually driven by the Fed policy as opposed to domestic fiscal policy, which tends to be the main suspect and the main explanation by every mainstream analyst to devaluations, I hope could help create at least some space to prevent the type of countercyclical policy behavior that we end up seeing in these scenarios that are not caused. And what's really tricky here is that it's not caused by a real economic phenomenon in a way. It's often caused by the perception of the real roots of of what are the roots of the type of exchange rate movements that we perceive. So anyway, I just wanted to bring, because we're in Brazil and sometimes the question of policy space is perceived in a very different way in different realities, I thought I would bring the question of inflation here as one for us all to discuss. Thank you. Bye-bye.
Thank you very much, Laura. I will give the floor to Chandru, please.
Thank you. I want to follow up the two very insightful presentations by merely trying to ask the question, if we are looking for sort of recovering and consolidating policy space in developing countries, which we know has over decades now shrunk quite considerably, is it enough to think about reforming or retrofitting the international financial architecture, or are we actually looking for something much more in order to be able to create this policy space? We normally associate the loss of policy space with, of course, the fact that there's a kind of integration of developing countries in a subordinate position into the global economy, into the global financial system and the global economy, such that they are in a position where they are not able to exert adequate autonomy when it comes to a range of policies. And these policies need not only be macro policies, which we tend to speak of, which is fiscal and monetary policy, but it could also affect the way in which you adjust your trade policies, your policies with regard to foreign direct investment, and so on. If you look at it in those terms of this integration into the world economy, we know that the extreme form of integration which we historically have experienced was, of course, the colonial period, when we had colonial governments which actually looked to the interests and objectives of metropolitan capital in order to be able to decide what they do on multiple fronts. And this was a period, therefore, what you actually had was an experience in which there was complete synchronization of cycles at a much lower level, of course, of economic activity, but synchronization of cycles between the colonies and the metropolitan centers. Periods of boom in the world economy, but booms also in the colonies to the extent that primary product prices, for example, went up. But you also ended up in the situation where you had a state which was not going to, in a period in which you were seeing a slowdown in growth, when things were not so good, which would actually exercise its ability to be able to undertake enhanced expenditures or expanded expenditures in order to deal with that kind of a slowdown. So you had this situation where, I mean, integration meant you didn't have the option of policy choice, and the absence of policy autonomy essentially meant that you were integrated in terms of actually having your cycle synchronized, but as I said, at a very low level of economic activity. With decolonization, we know that in some sense, governments in newly independent countries basically tried to address that problem of the experience they had under colonialism, or let's say under sort of earlier forms of sort of subcolonialism, let us say, which was that they decided that it was necessary to actually intervene to a certain extent, insulate or delink themselves from the international system. And the typical measures which were used, of course, were protection, capital controls, certain degree of regulation of foreign direct investment, mediation of the relationship between domestic and foreign capital by the state, because domestic capital was not strong enough to stand up, etc. So basically the idea was you tried to delink as far as possible. You, in some sense, tried to create for yourself domestic policy space by actually overcoming what you thought was the fundamental problem in neocolonialism, which was the absence of economic freedom because of the fact that you were completely integrated into a system in which the objectives of policy were determined by the metropolitan center. Now, this did not mean, of course, at that point of time that you had complete policy autonomy. You did not have complete policy autonomy, partly because of the fact that you were in a subordinate position, which essentially meant that to the extent that you couldn't be completely autarkic, any attempt to try and sort of reflate the economy or to push economic growth at any level of the import intensity of domestic production and consumption could actually end up with a situation where you had a current account deficit, which increased. And that current account deficit had to be financed. And at that point of time, really the only sources of finance which you had from the international system was foreign direct investment, to the extent that from the supply side, investors were willing to come. And so-called development aid, not that all development aid, it included, of course, credit, because a lot of development aid was essentially in the form of credit. But these were the sources which came. But the credit also which came was dominantly bilateral and multilateral credit, which was determined again from the supply side. So you had a binding constraint in terms of the level your current account deficit could go to, and therefore policy was constrained. You are always, in some sense, looking to the external sector, given any degree of dependence on international markets, which couldn't completely overcome and become autarkic. You are looking to the current account deficit to see how far you could go in terms of exercising the autonomy in policy you had. And of course, you had to increase that autonomy essentially by, in some sense, trying to delink to a greater extent, to enhance domestic production, to substitute for imports, to control the outflows or the drain of surplus because of transnational investment, and of course to try and limit the extent of borrowing that you would indulge in, because that obviously added to the interest rate outgo, which affected your current account deficit. Now, so therefore, it's not that you had full policy autonomy even then, but the point is, to the extent that you had these current account deficits, you ended up with a situation that you had to go different points of time, independent of the size of the country, including large countries, which at one point or the other had to go to the international system for emergency finance, because they didn't actually have the ability to be able to deal with the level at which the current account deficit was. And associated with that was the prescription of conditions, normally by the IMF, or the IMF and the World Bank, which to a certain extent required you to adjust, and the adjustment required you to reduce your current account deficit, but the reduction in the current account deficit was to come not through imposition of additional controls, because of the fact that that was seen as suppressing balance of payments vulnerabilities rather than resolving balance of payments vulnerabilities. So what you needed to do, that till such time as you can improve your ability to be able to earn foreign exchange to finance an import bill and the outgo foreign exchange for primary payments in the current account, you basically needed, instead of resorting to measures of that kind, you basically needed to, reduce the level of domestic absorption and economic activity, which you normally did through getting the state to curtail its expenditures. And you tried to use, once again, what was essentially a deflating mechanism, use devaluation as an attempt to try and curtail the level of imports as well as increase exports to the extent that well, whatever condition it may be, prevailed to give you an improvement in the current account associated with an effective and real devaluation. So therefore, you had begun to lose this policy space, partly because of this inability to be able to deal with the current account deficit in a context of international inequality. Now, in some sense, the change to this, or the third phase, if you want to call it that, really came when you actually had a transformation which occurred in the metropolitan countries as a result of the difficulties they faced at the end of the golden age, the coming of a certain degree of loss of export competitiveness on the part of the United States, and therefore the rise of finance, or the diversification to finance, and the rise of finance, and its effort to ensure some kind of a global spread in order to be able to obtain better yields as part of the kind of activity which we had then. And the adjustment had two components. One, of course, was the component in which you tried to deal with this loss of competitiveness for finding new sites for locating world market production, so that some developing countries or some less developed countries could become the sites which were instruments for battle of the transnational firms looking for low-cost locations. But you don't need too many instruments of battle given the size of the world market, and therefore not every country could do this. There were different points of time when different countries, some sort of referred flying geese and so on, but basically you had a limited number of countries. And once you have a country like China doing that kind of thing, obviously the number of countries which can do that successfully is limited, though all efforts to try and prescribe policies on how to get forward essentially tend to be ones which actually try to get these countries to grow based on external markets. And the other was, of course, to try and actually now move into developing countries, or look to developing countries not just as sources of raw materials and markets, as happened in the period during the golden age, but really to look at these countries as possible sites for accumulation based on the use of finance. And therefore, we began to see a movement of now not just the old kind of capital, which is, as I said, foreign direct investment and flows through the development aid network, bilateral and multilateral. You began to see private capital coming into the picture. This was also a period in which actually there was another transformation which occurred, which came with the Volcker shocks, which was the transformation in the metropolitan centers, where you moved away from from fiscal policy to monetary policy. And essentially that meant that whenever you did not have inflation, you essentially could have an easy money policy with relatively low interest rates, which provided the fuel for finance to go abroad in search of high-yielding capital, whether it be by borrowing domestically at home or because of the funds which were accumulated with the pension funds, the investment managers, and so on. So the issue then became that, listen, are you really going to use this opportunity to deal with the binding constraint which the current account is, by actually opening your borders to the flow of this kind of capital, which you did not allow earlier, or you're not going to? And most developing countries over a period of time actually chose that. And the implication of this was twofold. First, of course, it basically meant that there was one set of countries which began to accumulate large volumes of debt. Large volumes of debt which could be accumulated not just on the basis of private debt flows, but also from private creditors, but also increased flows which came from from multilateral sources of different kinds. And therefore, you had, starting from the 1980s, we know that that kind of an opening up basically began the cycle of debt crisis in developing countries, starting with the Mexican and Latin American debt crisis, and then moving on. The second was that even if you didn't happen to be a country which was so weak as to become quickly dependent on debt in a situation in which you're trying to sort of relax the binding constraint which the current account deficit was, to the extent that you opened your borders to the flow of capital and accumulated large volumes of legacy capital, which existed in your borders, and as Yilmaz accused said, I mean, these, in the case of most of these countries, were not earned foreign exchange reserves, which they accumulated as a result of the inflow of capital, but really borrowed foreign exchange reserves because they were associated with liabilities of significant magnitude. So you ended up with a situation where you had this legacy capital, which was footloose and really didn't belong to you because you didn't earn that. And the constant intention was not merely to, of the policymaker, was not merely to become attractive for the flows of this capital, because you were still stuck in the idea that you didn't want the current account deficit to be a binding constraint. But more importantly, the fear that there could be an exit of this put-loose capital actually begins to restrict your policy space. And that basically meant that what we have is a certain degree of path dependence because of the fact that you now are actually wanting not merely for capital not to flow out, but you want to always have the confidence of the international investor, because if you don't have the confidence which allows for more net capital inflows in excess of what is needed to finance your current account deficit, that could mean a loss of confidence which could actually result in those who are resident foreign investors deciding to walk out, to walk out. So therefore, you began to see that even when you didn't have balance of payments pressures, there was a significant loss of policy space, and the forms that it took in particular was the lost policy space with regard to fiscal policy. But as I said, it affected everything. It affected your ability to engage in welfare measures, which is seen as populist. It affected your ability to be able to impose conditions on foreign direct investors. It affected your ability to be able to impose any kind of trade controls or intervene in particular ways in foreign exchange markets, etc. And therefore, in some sense, what we have is that the situation seems to be one that if you want, I mean, on the one hand, it's extremely difficult now to regain or recover and consolidate policy space because of this path dependence, the fact that you've accumulated this legacy capital which might run away, or because in any case you're constantly tied up with IMF loans because you're a smaller country, which is not particularly attractive to portfolio investment, but is attractive to those bond investors who are willing to go even to the poorest countries of the world once there is a large amount of excess liquidity in the international system, as became true in particular after 2008. So the question really is it enough in this context to try and relax the burdens which are imposed on past flows of capital into these countries, and to try and get foreign investors, portfolio investors, to be a little more accommodating, as it were, and credit rating agencies to change their methods, etc.? Or do we actually need to think of the fact that you need to overcome path dependence and regain policy space? And the only way is you have to learn from the lessons which we learned in the colonial period and make rather sharp deviations away from dependence on international finance and on international markets. Thank you.
Thank you very much, Andrew. I'll give the floor to Ndongo.
Okay. Good morning, everyone. I have prepared a PowerPoint presentation on the. Okay. Yeah, it's fine, I think. Yeah. think it's okay, yeah. Okay, so thank you. I can hold it. Huh? Maybe I can take it, no? I can take it, okay, it's better. Yeah. Okay, I try. I try. So my presentation is about the topic of this session, policy space in a world of mobile private capital, reflections based on Africa. It is always difficult to speak after Prof. Chandru, so I will try to say the same things, but probably with less eloquence and with some example based on Africa. So generally there had been this discourse that Africa has been marginalized by globalization from the 1990s. And you could even see The Economist with the title of Africa being marginalized at that time. But generally what people do not realize is that there have been a strong growth of private capital in Africa starting from the 1990s, following, in fact, the structural adjustment policies, because the IMF asked the African countries to open their capital accounts. How could I? Okay. Okay. Oh yeah. Okay. And yeah, I try. I try. And as you could see here, we have been talking a lot about debt, but not necessarily about equity, FDI. And in the case of Africa, I always make the point that you could not understand African challenges if you do not give importance to foreign direct investment. Because foreign direct investment determines the earning capacity, foreign earning capacity of African states. Okay. Yeah, foreign direct investment determines the foreign earning capacity of African countries, and at the same time gives a specific economic orientation to these countries. And as you could see in this graph, in this table, there has been an strong increase of foreign direct investment stock. If you take the case of Sub-Saharan Africa, we went from 36 billion of stock. When we say stock of foreign direct investment, that means net cumulated flows over decades. So in 1990, it was 36 billion. But by 2022, it was 20 times that amount. You take the case of a country like Ghana, it was 300 million US dollars, but by 2022, it was 42.5 million. That means it has been multiplied by something like 133. The same thing for Zambia. I have given the case of Zambia and Ghana because these are two countries that defaulted on their debts in November 2020 for Zambia. You could see also that during this period, let's say after the, 2008, from 2010, there had been also a strong increase of the foreign debt stock. You could see that for Sub-Saharan Africa, it went from 250 something to 650 between 2010 and 2012. During the 2000s, there have been debt cancellation for heavily indebted poor countries, and also with a multilateral debt relief initiative. You could see that for Ghana, you could see that for Zambia, but nonetheless, you could see that generally speaking, we had a huge increase in foreign direct investment stock, and also a huge increase in the foreign debt stock. And you could see that in the case of Ghana and Zambia, the increase in the foreign debt, in the debt stock, external debt stock, has been driven by commercial debt, and especially the Eurobond issuances. You could see that for Ghana, it went from 21% in 2010 to 61% in 2020. For Zambia, it was 4.3 to something like 4.7%. So Yeah. And in the case of the, you could see that all these countries, they received strong inflows of foreign direct investment. They also issued debts a lot, but you could see that their external debt stock to export ratio declined. In the case, increased in the sense that, yeah, it worsened their solvency ratios from 88% in the case of Ghana to 140. In the case of Zambia, it was 53%, the external debt stock to export, to more than 300. And in terms of external debt service to export, it went from 2% in Zambia to 22%. So we could see that even before the pandemic, we know that this, situation was not sustainable. You only needed a drop in the prices of the commodities to have a debt crisis. And that's what happened. And generally speaking, even when we have these kind of indicators, in fact, they are not really, in fact, they are elusive in the sense that all of these countries, they do not have a national control over their export income, because the export income is controlled by foreign direct investment. So to some extent, even these indicators are elusive. And here, okay. Oh. Wrong way, okay. Oh, yeah, cool. And generally, people talk about the financing terms. That means the interest rates on external finance. But the thing is, very few people talk about the high returns on foreign direct investment. And here, it's some calculations I made about the foreign direct investment returns calculated. In fact, in the balance of payment, it's called FDI income, FDI primary income and FDI, and you divide that by the FDI stock, and you have the returns, aggregate annual returns on FDI. And you could see in the case of countries like Ghana, some years you could have 12% returns. And for many years, it has been higher than the returns on the outstanding debt stock. You see, that means if you look at the debt stock for one period, let's say this year, and you take the debt service and you divide it by the outstanding debt stock, you see that it's lower than the returns on foreign direct investment. And that means that there is a lot of economic surplus that is not captured by African countries, but rather by foreign companies. And generally, you could even see people say, oh, we want debt cancellation, or BlackRock doesn't want to negotiate the debt with Zambia, etc. But the same company, BlackRock, has also shares in mining companies, in extractive companies across Africa. And generally, people do not talk about this. And I think this is a really important issue, because it is one of the reasons that explain why these countries are generally in debt distress. And you could also see the same pattern for Zambia. And even for Zambia, some years you could have returns on foreign direct investment of 25%. So that means in a matter of less than 3 years, the capital invested is already recouped, you see. That's huge, and you could not find that everywhere. So another point I would like to make, and this also goes in the same way as what has been said here in the panel, for Global South countries, there are a number of features that are desirable, but they could not have together. These features that are desirable for me, for example, are having a relatively flexible exchange rate regime. I know there are many debates about the choice of exchange rate regime, but at least having a kind of managed float could help achieve, some domestic goals, focus on creating domestic jobs, have greater control over domestic interest rates, etc. But the thing is, also having low inflation rates also is desirable. And generally, in the case of Africa, the countries that have low inflation rates are countries that are in a fixed exchange rate regime. And countries that are in a kind of more flexible regime, generally they have high inflation rates. Another thing that would be desirable is to have regular developmental trade deficits, developmental current account deficits. I mean that, well, when you want to grow your economy, you have to import capital goods, equipment, raw materials, and it's good to have deficits because those deficits are developmental to some extent. But ideally, you would like to have them with low deficits in the primary income balance, you see. And the last thing is also to have some degree of monetary sovereignty. That means lower debt in foreign currency, lower sovereign debt in foreign currency, and also a control by the central bank over the domestic interest rates applying on government bonds. These four features for me are the ideal macroeconomic framework for the Global South. But the Global South, they could not have that, these four features together. It's impossible they don't have that because they have weak currencies and, you know, they don't have, they don't issue reserve currencies. So they have to navigate this environment. And I would like to give some example about that. Generally, the scenario you have, the crisis scenario is that you have current account deficit, regular current account deficit, you build more external debt, and at one point you have external debt payment difficulties, you have currency depreciation, high inflation, IMF austerity policies, and sometimes you could have popular uprising depending on circumstances, like what happened in Kenya, in Nigeria, etc. But the thing is, it's better to have a kind of what I would call a dirty navigation. That means, for example, countries in Africa and the Global South should try to have, limited sovereign debt in foreign currency, have moderate external deficits or an adequate level of external debt surpluses, relatively flexible exchange rate, and reasonable inflation rate. That means try to navigate all these together. But generally, it has been very difficult to have that, and you have very extreme, options. For example, if you take the case of the CFA franc zone countries, they made the choice of monetary stability. That's how they call it, because the currency is pegged against the euro. And so they have very low inflation rates. But the thing is, when you have a fixed exchange rate, you have to make sure that you could sustain the peg regime over decades, etc. And the CFA franc is anchored to the French franc until 1999, and since then to the euro. And it has been devalued once between 1948 and 1994, you see. So it's one of the longest, fixed exchange rate regime. But this has a cost. And the cost has been that, well, there has been a loss of competitiveness. And to maintain the peg when you have current account deficits, well, generally, these countries have been strongly reliant on foreign finance, foreign debt investment to buy their economies, and also on foreign debt. And there has been also very low domestic credit creation and very low levels of bank loans to the, for example, primary sector, especially to the agricultural sector. And in these countries, you have food deficits. And generally also there have been a kind of share austerity because all their reserves are poor because this is a monetary union. And when you look at their long-term performance, you could see that, well, generally, well, they have been poorer now than they were, let's say, in 1978. For example, the richest country in the CFA franc zone is Cote d'Ivoire. Its highest level of real GDP per capita was in 1978, and it has still not caught up. And you have many examples of these countries. So I'll go quickly to the conclusion. I would have liked to give the example of Seychelles, which is a rich country with also some monetary flexibility, but it has been going also through debt crisis. It has a flexible exchange rate. It has a chronic current account deficits. So at one point you have you need debt restructuring, and one instrument they used was natural debt swaps. You have also another country like Botswana, who is a net exporter of capital. They have current account surpluses, regularly speaking, but despite that, there is a huge unemployment in this problem. So that means that whatever option you choose, it's really difficult. So what I would like to say in conclusion quickly is that, in fact, developing countries need to incur, developmental trade deficits. Otherwise, they could not grow. But the thing is, this current international system punishes them for doing that. If you try to do that, you will have current account deficits like Chandru said, and it's not the countries having current account surpluses that we have to adjust. The IMF will come for you to adjust. And So it's really difficult for this country. But what is specific about Africa is the fact that the foreign earning capacity is determined by foreign direct investment. So the terms of financing are not that good, but at the same time, you don't have a national control over your foreign, over the sectors that create the foreign exchange earning. It is as if these countries were still in a kind of a colonial system, you see. So the current international system says to African countries, we don't have adequate financing for you. We are not ready to give good prices for your export of raw materials. And if by chance you have good prices, all the gains will accrue to foreign companies. So that means that if the export income increases, that not translate automatically in foreign exchange accumulation, for example. And that's what happened, for example, in Zambia. So in this context, there are two things I think that could be done. The first thing is that if these countries are allowed the option to have these developmental deficits, that's fine. But if they are not allowed to do that, I think what they could do is to rely more on their domestic resources. That means that instead of depending on foreign technology, foreign equipments, they have to tailor their own development based on the real resources they could command in their own currency, or also they could command through regional integration. And we now see that there is a trend toward de-dollarization, and there are alternative payment systems available. So if the international financial system in its current form does not change, I think it's better to go that path instead of depending on foreign finance and having to incur regular, debt crisis. Thank you very much.
Thank you very much, Ndongo. Thank you to all speakers for their brilliant talks. I will open three questions for the audience. Matthias?
Matthias Renengo, Bucknell
First
University.
a set of three questions, then...
Should I go or wait? I probably wait. They're not paying attention even to whether I'm go or wait. I'll point to.
Me?
Oh, Fred, should I go or?
Yeah, Matthias.
Okay. So, I'll be brief, but I have actually three questions. So I think I'm gonna, shut down this. So, for Martin, and I don't want to put you on the spot, but I'll put you on the spot. You were saying that it's, for most countries, too late, too little, too late. And the question for you is, isn't that the case for Argentina already? Aren't we in a situation in which we already have to restructure the debt? So is this payable? For Laura, very short question. The devaluation of the real, isn't it just we're reaching the limit of how low we put the interest rates? So unpopular as it might be, isn't that the case that the devaluation of the real is basically associated to the lower interest rates? Then for the panel as a whole, my question is, there is a sense in which the space, even without discussing that policy space is to some extent endogenous to policy itself, but the policy space for developing countries in the last, 20-something years, so in the 21st century, given the low rates of interest in the United States and most advanced economies, which seems like they're coming back, probably not as low as they were for a good chunk, but it seems U.S. is going to start lowering the rates again. And the high growth of China and some other countries in the global south, as they say, which is lower than it was before, but it's still relatively high. That it creates the conditions for for those countries that don't do the things that you guys been saying, don't borrow in foreign currency, that accumulated reserves, and so on and so forth, that they have plenty of space. So those are the questions.
Yes. Is it me or?
No.
It's me, right? Okay, yeah. Yeah, thank you for the very, very interesting talk. I have a question for Martin, and then I have one for Ndongo. So Martin, I think one of the proposals that you mentioned was to change the recent exposures of low middle income countries to international private sector through MDB guarantees, right? I mean, this is already happening through the World Bank Evolution Roadmap. And my question is, are we talking about a better regulation through the MDB's role for the private sector, or are we talking about a transformation of MDBs to better integrate and almost steer the role of private sector? Shouldn't the emphasis be on protection of the public sector through more conditions for the private sector? So I would like your thoughts on that proposal. And for Ndongo, I think in terms of developmental policy space, something which is really happening, interesting things are happening in the African continent. And more recently, Burkina Faso, Mali, and I mean, these countries are withdrawing from the regional blocks. How do you see that progressing in the future? Thank you.
Yes, this question is inspired by Laura's presentation that the inflationary pressures really stem from external sources rather than fiscal policies. That's what's inspired me to ask this question of Martin. I was, let me just give you a brief thing here. I was having a difficult time going through the formal process of obtaining a visa to go to Argentina. So as a former parliamentarian, I used the usual connections. And I got the visa in less than a week. But what was surprising was when I went to the Argentine embassy, a high Argentine diplomat came up to me, very interesting, and proceeded to give me a 45-minute lecture on the Argentine economy. And I guess that was because of the friendship among diplomats, right? So, but what he proceeded to say was the Milei narrative, which is basically saying that inflation in Argentina is really caused by fiscal irresponsibility, by governments that did not want to tax and had no access to external resources. Now, as somebody who has critically evaluated neoliberalism, I could see the flaws in the argument. The problem is, with people who are not quite familiar with the neoliberal argument, it could become very convincing. And so what I would like to ask is, as a former minister, what is the counter-narrative that is being presented now to the people in Argentina to counter what seems to be this convincing narrative on the part of the current government? So yes, I'd like some. Yes, that's the question. Thank you.
Before coming back to the table, I allow three other questions. That gentleman, Jose Antonio, and the lady.
So it's my turn? Yeah, my name is Ray Jingosi. The question is simple to all of you. By the way, thanks for the good presentations, gentlemen and lady. Keynes tells us that let finance be primarily national. And against that, there is Article 6, is that, in the IMF, where we can block unnecessary footloose capital. Of course, there is legacy capital as well. And China that we see today has largely been a success because of its finance being primarily domestic. Are we perhaps from other developing countries outside of China saying that we have deliberately sabotaged ourselves? And or are we suggesting, as Jan Kregel here did say, that we have succumbed to the globalist agenda? And so how do we retrofit then all this, if at all there is necessity for us to do that, or shall we transform it fundamentally to domestic capital? Thanks.
Thanks so much. No, not me. Oh, sorry.
No, go ahead.
Go ahead.
No, go ahead.
It was your turn.
By by looking at the initial graph of Martin and then the data from Ndongo, one thing that is very clear to me, the way I will express, which I actually learned in a conference I went over the issues of debt in Ghana, actually, a few months ago. But the over-indebtedness of sub-Saharan Africa is largely associated to private capital flows that came in large amounts after the monetary policies of the U.S. and Europe after what is called the global financial crisis, which I call the North Atlantic financial crisis. So somehow looking at that, first of all, very peculiar, but I think it's a similar story in a sense to the Latin American debt crisis, because there was these surpluses of the oil exporting countries that were recycled into Latin America in large amounts in the 1970s that led to the Latin American debt crisis, and now this surge for higher yield bonds based on and other financing after these policies adopted by the Fed and the European Central Bank, etc. That led to the crisis. So one point, I think one element in both cases is that you also need domestic policies to avoid over-indebtedness, which was missing in Latin America in the 1970s, actually with one exception, which was my country, Colombia, which that's why Colombia did not get into the Latin American debt crisis. And on the other hand, in sub-Saharan Africa, with these two cases that you presented that were absolutely critical. So you have to have domestic policies to avoid over-indebtedness. Of course, when you get into over-indebtedness, you have to go to Martin's solution or see what the hell we do to reduce the over-indebtedness.
Sorry for speaking out of turn earlier. Thank you so much for the fascinating panel. First question to Martin. You had a table which showed sort of that there was large-scale transfer of public resources to private creditors. I was interesting to know, how do you explain the trend for China? Because there was a negative 5 point something there. And so I would really like you to explain that, what that means, basically. And second, I was wondering in terms of alternatives to the present Bretton Woods institutions. A lot of people have argued about Chinese finance comes with different terms, easier terms, typically, and also longer duration of loans as compared to international financial institutions, specifically IMF, World Bank, etc. And so what role does this have to play when it comes to sort of creating policy space in developing countries for the goals that we need to achieve? And second, to Laura, I thought your presentation was really fascinating as well. You specifically mentioned in terms of, I guess you called it the inflation constraint, and and maybe I'm wrong, but I guess I want you to comment on this, is that you focus a lot on like what central banks can do, and of course buffer stocks as well. But clearly, like in a lot of developing countries, especially now, it's very obvious that inflation is not to do with demand at all, and therefore we need more broad-based response to inflation that isn't sort of just related to monetary policy entirely, when in fact, like what we're still teaching students is that, yeah, well, monetary policy, central bank deals with it. So how do we go about changing the narrative on just that you don't only need to rely on the central bank to raise interest rates to deal with inflation? Thanks a lot.
Well, I propose to follow the order of presentation in the answers, okay? So first, Martin.
Okay, I got 6 questions, so I hope you give me some time. Matthias' question, I mean, probably most people here don't have the knowledge of the situation that you have, so I have to provide a little bit of background. Matthias' question was about whether Argentina needs to restructure the debt now, basically. So he related this to this syndrome of too little and too late. So a bit of background. Argentina had a deep economic crisis in 2001. It was the worst economic and social crisis in our history. And after that crisis that included the debt default, it restructured the debt in 2 rounds, 2005 and 2010. But it had a long dispute with a group of bondholders who had bought debt at a deep discount and sue the country. They are called defaulter funds. That dispute was finalized in April 2016. And when it was finalized, the government of Argentina by then, 2016, returned to the international credit markets and borrow in foreign currency and under foreign law. Only 2 years later, Argentina again lost access to international credit markets, 2018. What was the response to that? The largest loan ever from the IMF with the support of the Donald Trump administration in the United States to support the government of Argentina by then, which was a political loan. So first thing, that was a moment in which a restructuring was needed. The IMF recognized in 2021, in December, in an evaluation that it published of that loan, that in 2018 there should have been, they call it a debt operation, which basically means a restructuring. So by then it was too late. Then the restructuring happened in 2020. I was the finance minister. And it led to an extension of maturities, reduction in the interest rate, a significant reduction in the interest rates. But the debt started to come due again last July, meaning less than a month ago, July 9th. And still there is no access to international credit markets. But I spoke of 2 different libraries, one that focuses on the problems of commitment and the other that focuses on the problem of sustainability. So the government of Argentina says that the country is going to tolerate any needed pain in order to repay the debt. So according to that library, if there is enough commitment, the country is going to access again international credit markets at some point next year. The other literature would tell you what's your view on the model that is being implemented, the economic policies. Are they going to deliver more productive capacity, and especially more productive capacity in the tradable sector of the economy, such that the country can collect foreign currency to repay the creditors? Well, that depends on your opinion. Of course, my opinion is that that's not happening. Actually, the productive capacity is being harmed. So ultimately, Matthias, it depends on the views of who is analyzing this situation. Second question was on the changing the exposure of low and low middle income countries to MDB's guarantees in the proposal. So what's my view and the view of some of us there on that point? First, that countries, given the way the international financial architecture works, should not borrow, should try to avoid borrowing from the IMF or from Wall Street creditors in foreign currency under foreign law. That, of course, puts a limit to the capacity of countercyclical policy, but in any case, when they borrow from these creditors, it's not necessarily used for countercyclical macroeconomic policies. When the evidence of borrowing from the fund goes against that. But being able to borrow in domestic capital markets requires more developed domestic capital markets. And if we want foreign investors to be part of that domestic capital market and not play a destabilizing role, there should be capital account regulations. that prevent from a hot money from exploiting carry trade opportunities. So those investors from abroad who want to invest in the real economy and they have liquidity in the local economy and want to play in the domestic capital market, that's fine. That's not the way borrowing in low-income countries and middle-income countries after the 2008 North Atlantic financial crisis occurred. They were not prepared, the architecture was not prepared for that kind of borrowing. So we think that had to be reverted. Ideally, there will need to be money from global institutions playing the role they're supposed to play now, but that's not going to happen right now. So the MDB guarantees means gaining time. You don't need to put the money now, you need to put the guarantee, and eventually, if it's not possible to roll over the debts, we hope by then there will be more financing, and if there is not, there has to be another step of a solution. Third question, I'm getting there, sorry. The counter-narrative to the government of Argentina, no counter-narrative now, except for dispersed narratives. That has to do with the political situation. The country has been in a process of stagnation since the commodity boom was over in 2012, and the new government is new. It's 7 months, almost 8 months old, so this takes time. There will be a counter-narrative at some point because things are not going well. There was a question on domestic financing. I think I responded that. That was number 4 when I responded previously. The 5th question from Jose Antonio on the Latin American debt crisis of the 80s and the current crisis. Certainly there are similarities. It's the international global conditions are the ones that are the main determinant of borrowing in developing nations. But there are also differences. Today, the base of creditors is different. In the 80s, it was mostly American banks, and the way the debts were valued in the balance sheets were different than the way investment and hedge funds do it now. So the mark-to-market changes the nature of debt crisis resolution. By then, in the 80s, the American government used its foreign policy to avoid restructurings until the end of the decade with the Brady Plan, and they destroyed Latin American economies. Several of us ended with hyperinflations. The situation is different now. But at the same time, indeed, Jose Antonio, domestic policies are the ones that need to avoid the over-indebtedness. Not just policies, but legal frameworks. When I was finance minister of Argentina, I pushed, successfully in this case, adoption of new legislation for giving more involvement to the National Congress for the indebtedness in foreign currency and under foreign law, and from the IMF. That has to be approved by Congress now, which helps to deal with the domestic political economy problems. Governments, I mean, they may want the money right now to win elections. The last question from the Vika. China. China is part of the problem, although now things are improving a little bit. But the main culprit is the private sector, the international private sector. Okay, but when you look at the data, you see that since the beginning of the commodity boom, debts with China have been increasing. When you mention alternative to Bretton Woods institutions, do I think that Chinese financing can resolve the problems of development in our nations, in this region, for instance? No, no. That kind of financing is mostly for projects that benefit China. Sometimes they benefit the countries. Infrastructure projects for transportation of commodities, so you get cheaper commodities. When you look at the patterns of trade with China, our region exports primary commodities and imports technology or manufactures that require technology. So that replicates colonial patterns from the past. It doesn't play well for the development of the nations. Sometimes it's the best options that the nations have because the others are too bad. They are even worse, okay? But that's not going to resolve the problem. So that's why in the way the global economy works, in which power relations are key, foremost, the first determinant of how institutions work, I would vouch for regional financing and a growth of the regional development banks in our region, the CAF. I'll stop here. Sorry that I had so many.
No, I only have two, and I'll try to answer in one. For the question on demand push inflation or cost push inflation. So just to make it clear, the way I'm talking about an inflation constraint and the role of central banks is not at all assuming a demand-led type of inflation. The problem that I'm talking about is that when you have a reversal of flows, of capital flows that then generate an exchange rate depreciation in emerging markets, you have two options if you want to avoid the inflationary pressure that comes out of the exchange rate deflation through costs, right? Import costs plus firms adjusting markups upwards due to the gain in competitiveness. So there are several channels by which the exchange rate devaluation translates into inflation. Demand, I think, is not a very relevant one. But in that scenario, central banks that are facing that inflationary pressure, they either raise interest rates to stop the devaluation of the currency, not to control demand, but to actually stop or at least reduce the capital outflows. They end up acting through the exchange rate channel a lot and trying to create an exchange rate anchor to inflation. And so that's how they lose their degree of autonomy, even if there is no overheating or no demand pressure or any of that. The other option they have is to sell reserves or engage in kind of currency swaps or other mechanisms to intervene in the exchange rate market. Some central banks have been doing both, but ultimately, if the pressure continues, they end up raising rates in this scenario. And that relates to Matthias' question. Of course, the devaluation, the level of devaluation that different currencies face have a lot to do with their level of exchange rate, of interest rate in each moment. So whenever, sometimes, and it was true, for instance, in Brazil, I think maybe 1.5 years ago, there was a moment of devaluation, and Brazil's interest rate was below the other emerging markets' interest rates at that point, and maybe that was one of the big causes of Brazil having devalued more than other currencies. But in this particular moment, I'm not sure it's the case. I think Brazil has devalued quite a lot last month, and the Brazilian interest rate is actually higher that almost all in real terms, it's that almost all the interest rates of other emerging markets right now. So I think it may not be the only cause for Brazil to overshoot in relation to other emerging markets currencies. I mean, there are some people like Pedro Rossi who have been looking at derivatives markets and futures markets that do claim that there is a bigger weight of these markets in determining the Brazilian exchange rate than other emerging markets. It's not my big topic of research, but maybe that's an additional reason. But I think to conclude, that constraint, I think, plays out in different levels because, of course, one of the problems is counter-cyclical monetary policy and how then in periods of crisis, you end up having the interest rate respond. Even if there is a recession or a crisis in demand, still the interest rate responds upwards to stop the capital outflows and appreciate the currency. But the second problem is a fiscal counter-cyclical policy, which I think is maybe the political economy piece that I was trying to bring, which is no matter what the actual sources of inflation and devaluation are, even if they are external, still the policy space is reduced for fiscal policy as well, both because of the higher interest rates and the fiscal costs of that and how they translate into higher debt, right? That would be the economic part of the story. But also because of the way the movements in exchange rate and inflation are interpreted by market participants and economic analysis in the countries. And these analyses end up associating all these movements with the fiscal policy, no matter what the fiscal stance is. And I usually joke with journalists, like you have this devaluation, the dollar goes up in one day, and then everyone is looking at what the last statement of the Minister of Finance was, or the last statement in the Congress, or who said what that who could have led market participants to be panicking. And in fact, when you look at the Mexican peso, it had the exact same movement. When you look at every single emerging market currency, it had the exact same movement. But still, the news are about whatever led people to think that the fiscal responsibility was not as expected. And so there is a part of it that requires a counter narrative, I think, as you mentioned. And that, I think it's up to all of us to work on that counter narrative.
Thank you, Chandru.
Just 2 quick points. First, Matthias, I don't understand what you mean by saying that there is plenty of policy space. Essentially, if you're making the point that you can think of ways in which countries can pull themselves out of underdevelopment and backwardness, of course, there's a plan. You can have a conspectus, which basically says how you do it. But if you actually say you're integrated into a world system which doesn't allow you to do it, then you're asking the question, is that integration something which, in some cases, that's policy choice to actually get integrated. In some cases, it's enforced by circumstances. It could be a commodity price shock, it could be COVID pandemic or whatever, which pushes you into a situation in which you get indebted to a degree in which you lose policy space. So it's in that sense. And to just add to that, the point about national, should finance be national? Keynes's thing. But what we're really looking at is, it's not that finance cannot be national. It is that in a world in which you need to earn foreign exchange through transformation, through trade or other means, and you're not able to do it because of fundamental inequalities, you become subordinate to global capital, whether we want finance to be national or not.
I will jump on that question too, but maybe with a slightly different perspective. Well, Keynes also said that whatever we could do, we could afford. But the thing is, most, at least African nations, they are following an economic model they could not afford because their economic models is highly reliant on, external capital goods, equipments, etc. But what could be done, for example, is to, for the least developed countries, to base their development on their domestic real resources and leveraging, for example, regional integration. For example, most of these countries are food deficit countries. They could themselves achieve food self-sufficiency, and they could mobilize their, domestic financial sector for that. They do not necessarily need foreign capital for that. But they are not doing that because there is this idea that we need the foreign exchange. But you need the foreign exchange to do what? To have access to foreign goods you need. But if you start from a low level of development, I think you should start by mobilizing first your own domestic resources and also try to have payment possibilities that allow you, for example, to import critical goods, etc. When Professor Patnaik talked about a number of rights, all these rights, when they have to be implemented, they do not necessitate foreign currency, but domestic currency. So that means that we have to think first about the economic model. What is the economic model? And what are its requirements in terms of real resources? And after that, what are the payment possibilities for the external real resources we need? About the, I agree also with Jose Antonio Ocampo about the need to have domestic politics that avoid over-indebtedness. That is really important for African countries. About the Sahel, it's a very difficult situation, Fawa, because These are 3 countries belonging to the franc zone. They are using the CFA franc, and they have been, suffering from the destruction of Libya, because when the NATO, UK, France decided to invade Libya and to destroy it, in fact, they created the space for regional instability. And these countries have been suffering from that. And they could have benefited from regional integration, but unfortunately, the Economic Community for West African States, which is the regional gathering, has been captured by France, the EU, and the US. And this ECOWAS, instead of helping these countries, they have been sanctioning them financially. So it has been very difficult for them. And as these countries are landlocked, they have climate challenges, etc., among the poorest in the world, they need net transfer of resources. But if they have to depend on foreign finance, I mean, they will go through, a recurrent debt crisis. So it's a really difficult situation.
Thank you very much thank you all very much. I invite all of you for a coffee break.